Hello, my name is Thomas Key, and I am President and CEO of Stock Traders Daily. Today, I'm going to present you with a game plan to make between 20 and 30% between the remaining few days of October and the first few days of January 2014. We are going to review 3 markets and ETFs for each one of these markets. Those are going to be the S&P 500 and SSO and SDS respectively. SSO is the double long, SDS the double short for the S&P 500. We're going to look at the NASDAQ and QLD and QID. QLD the double long, QID the double short. And we're also going to look at the Russell with UWM the double long and TWM the double short. I will also talk about the Dow Jones Industrial Average, but as you will see, the Dow Jones Industrial Average is not moving exactly like these other markets. We are looking for opportunity through the remaining part of this year, and using these markets we can find it. Let's start with a basic chart analysis of the markets that we're looking at. This is the S&P 500, and as you can see, this upward sloping channel in the S&P 500 has been intact since the middle of June. The market has increased to resistance, back down to support, back up towards resistance, and again throughout the course of this time frame. It is currently poised to increase back and test upward sloping resistance, which exists somewhere above 1775 according to this chart pattern. That means that there's upside left in the S&P 500. The same is true for the NASDAQ. It's a more aggressively sloped chart pattern, but there does seem to be upside potential to about 4,000. And in the Russell as well, there seems to be additional upside within this chart pattern that is consistent between all 3 of these markets. The Russell seems poised to test 1140. Next, we'll take a look at the long ETFs for each one of these markets. This is SSO, the double long for the S&P 500. And just like the S&P 500's chart, this chart pattern suggests slightly higher levels. In fact, there's a skew here because of this breakout that occurred in May, but that was after this chart pattern really began. So, although this chart pattern does say that we should expect about 94 from SSO, it could skew slightly higher than 94. That's important for us to recognize. It's also important for us to recognize that the NASDAQ ETF is also suggesting higher levels. The NASDAQ is suggesting higher levels and about 92 from QLD, which is currently at about 88. So the NASDAQ's ETF is supporting what the other markets are saying and the ETF for the S&P 500. Turning to the Russell, it too suggests higher levels before official tests of that upward sloping resistance line occur. So the markets are in parity and the ETFs associated with the markets are also in parity. That's important. We like to find a cohesive parity between the markets that we follow to convey a combined analysis. Next, it is important for us to take a look at the stock reports for these particular ETFs using the stock reports at Stock Traders Daily. Start with SSO. According to the chart pattern for SSO, we're looking at resistance somewhere near 94.82. be more clear by opening up the longer term pattern. 94.82 is the upside target for the SSO according to the longer term plan. The midterm plan has 93.69. So if we balance that, we're looking at somewhere slightly over 94 for an upside target from SSO, which is in line with the chart patterns that we just looked at. Turning to QLD, the interesting part about QLD is that our real-time trading report shows us that QLD is actually breaking out beyond the longer-term resistance line that we have in our trading report. This is interesting to note, and I'll reference it again in just a minute. But let's make sure that there is a parity before we do by taking a look at the Russell. The Russell, just like SSO, just like the S&P 500, is supporting higher market levels and somewhere between 80 and 81 as an upside target for UWM, the double long on the Russell. So that outweighs the anomaly in the NASDAQ. In fact, what the NASDAQ actually could be telling us is that it could turn down faster than the other markets, given its respective relationship, if these other markets hold their respective resistance levels. That's important to recognize. We'll talk about that again in a minute. But the point here is that our real-time trading reports are supporting the target of resistance that are offered not only in the charts of the markets themselves, but in the chart patterns of these double long ETFs as well. So going back to the chart pattern of the S&P 500, what does this mean to us? What this means is the market is expected to rise a little more, target 1780 or so, before it faces major resistance, given this chart pattern that extends back to June. That has been pretty consistent. And if it does hold this resistance level, that will be a sell signal and an opportunity to short the market. This resistance level has proved to be an opportunity to short a number of times already. And the oscillation down to support each time has been fruitful. It also has taken roughly a month on average to come full circle. In other words, to go from resistance to support has taken about a month to happen, with, of course, backing and filling along the way. So, if this pattern repeats itself and we see the oscillation towards resistance that the S&P 500 and the other chart patterns are suggesting, we should consider that an opportunity to sell and an opportunity to engage the short side of this market with the intention of letting it ride back down to support. However, we're not going to make any money with those long-based ETFs if the market moves from resistance back down to support. So we have to look at the short ETFs. And this is the double short SDS on the S&P 500. Conversely to those double long ETFs, this suggests that additional downside is likely before support levels are tested here. Let's look at the double short for the NASDAQ. Again, the slope is more steep than the S&P 500, but it too suggests downside. Somewhere near 1625 maybe. And the double short for the Russell, also suggesting lower levels, more aggressive I might add, than either the S&P or the NASDAQ. So all of these double short ETFs also suggest that the market can move higher, because they will fall if the market moves higher, that the market will move slightly higher before turning. But once the market does turn, these ETFs can be bought with the expectation of a progression higher to the resistance line. That's very, very important to recognize, because that's where the opportunity comes from. Back to these real-time stock reports. This one's for SDS, the double short on the S&P 500. And the longer-term data suggests 31, roughly, as a downside target. It's telling us to expect it to fall down towards 31 before such time as it starts to turn higher again. That supports the notion of higher market levels. But it does something else. It also gives us a rough upside target. In this case, 37, which is a nice return if it would move from near support to near resistance, which is what we'll also observe in the channels when we look back at these double short ETFs for the actual opportunity. But before we do that, of course, let's see what the double short for the NASDAQ is telling us. And it's telling us something similar as well to those longer term charts that we just looked at. 16.37 is the downside target. It's telling us to expect slightly lower levels from this ETF before it finds legs and turns higher. But when it does turn higher, the upside target is about 19.7. That's the upside target right now. It may change. These things are dynamic. And there are downward sloping channels involved like we just looked at. But for right now, that's the upside target if we fall down to 16.37. Let's do the same thing here for the double short on the Russell. The double short on the Russell tells us, very similar to that chart pattern, that we should look for just over $12 from TWM as a buy signal. And if it holds, we should look for just over $15 to sell that position, which again is a handsome return. Let's take a look at the chart patterns again. This is the chart of the double short ETF SDS for the S&P 500. It's telling us to expect roughly a 3% decline, which is roughly a 1.5% increase in the S&P 500. But it's telling us to expect about a 3% decline in this SDS position before it tests support and begins to turn higher. If this channel remains intact and support is held, the net return, which would take roughly 1 month, that's the average, roughly 1 month to transpire, should give us about 14%, given the channel that's been in place since June. For the NASDAQ, the channel is very similar, with a little more bang for your buck, because the NASDAQ's been moving faster. The return somewhere in the 18% range if 16 and change is tested and we reverse back to 19. And the Russell, telling us basically the same thing. there is a handsome return probability if support holds and we traverse back up to the resistance level. It can be very handsome, in fact. So, step number 1 of this game plan is to look for an opportunity to buy the short-based ETFs when the market itself begins to test resistance. And that's somewhere near 1780 according to our current chart patterns. When that starts to happen, we should absolutely considering selling out of the long positions that we currently have and converting to the short side to take advantage of what is approximately a 15% return probability depending on what market that you choose. However, and very importantly, if the market tests resistance and falls back to test support again, and it takes roughly 1 month to happen, we're going to be somewhere in the middle of November when the market is testing the support line of this channel again. And that's going to be a buying opportunity. A buying opportunity that could result in the market coming all the way from support back to resistance again through the remainder of the year and probably a little bit into the next year. And if that happens, not only can we get 14–15% on the downside using the short-based ETFs, but we can turn around and get the same return on the upside within this same channel. And in fact, there'll be more bang for your buck if the channel remains in place and we buy at support, because that's the nature of upward sloping channels. So the opportunities, they're solid here based on the existing channel that we're looking at. That's congruent between the S&P 500 and the NASDAQ and the Russell. These are very, very important because we look for parity like this to find opportunities, and there is parity here. Our reports are supporting the same thesis. Our real-time trading reports tell us to look for opportunities to buy those short-based ETFs with the expectation that the market's going to move a little higher and then turn down. But that's only half of the story. Because these channels are upward sloping, we should not hesitate to buy at support. And if we do that, we do both of these things, we can achieve a 25–30% return between now and the first part of 2014. So here's the game plan. But before I tell you all of these details, which you probably already can surmise, I want you to also remember that these are based on technical chart patterns, and these technical chart patterns will adjust as prices adjust. We're looking at upward sloping and downward sloping channels, and by nature, as time goes by, in downward sloping channels, resistance lines are going to get lower, and in upward sloping channels, support lines are going to get higher. So we need to respect those adjustments as they happen over time. I will, of course, continue to update everybody as we continue with this game plan. But the current game plan is to watch for about 1780 in the S&P 500. By the way, the game plan I'm illustrating here is for the S&P 500, but you can use the NASDAQ, the S&P 500, or the Russell to take advantage of this. They're all in parity. But with respect to the S&P 500, we're looking for about 1780 or so. At that particular time, we'll begin considering the short-based ETFs. That means we're going to look at buying SDS. At that same time, we want to sell our long-based ETF, the SSO. We want to get out of that. and convert basically to the SDS position, converting at resistance at 1780. Our intention will be to cover that position at about 1675. That's where that support line exists today. Again, it can adjust, but given the current channels, a decline to 1675 is what we would expect if it happened promptly. At that point, we would sell the SDS position and convert back to the long position. If we were able to sell the SDS position, we're going to get a very handsome return. We'll call it 14%. And if we're able to convert back and support holds, we're likely to get even more than that on the upside because we're in upward sloping channels. That means that resistance lines increase as well over time. So if the channel remains in parity, resistance is going to be over 1780 next time. So this could be a very lucrative position. But if it also is engaged towards the end of November, let's say, it also may be a position that we don't even need to sell. We don't even need to realize the capital gains, in other words, until 2014. It could work through the first week or so of January. That means the intention, if we're able to capture the gain from the short side and then buy this SSO position, given the S&P 500, the intention would be to let it ride through the remainder of the year. The objective here, of course, is to make money first on the downside and then convert to the long side of the market based on the chart patterns that I've illustrated using the double ETFs. And if we do that, and we pay attention and respect that channel, we absolutely can realize a return of about 30% between now, October 26, 2013, and the first week or so of 2014. If you have any questions at all, please let me know by email. In addition to that, if you would like me to do this work for you, please let me know. If you want me to do it, you need to act fast, because we're likely to see some triggers here in the next couple of days. So if you want me to do the work for you, please let me know. But this game plan is something that you can execute yourself if you remain disciplined. This looks like a very, very good opportunity to me to make money first from the short side and then from the long side of this market as 2013 comes to a close. Thank you very much.